Hi, I'm Thomas. Welcome back to the course Financial Management. Today's topic is time value of money. The key concept you need to remember to understand time value of money is that a dollar today is worth a dollar tomorrow. And what we mean by that concept is that if you have a dollar today, you can begin using it now to do whatever you want with it. You might want to invest it. And if you invest it today, tomorrow it will be worth a little bit more than $1 because of investment return. So this general concept we can divide into present value and future value. Present value means that if we're looking at a dollar amount that we will receive in the future, we need some kind of process or calculation to reduce the value of that dollar amount, to discount the value of that dollar amount so that it is equal to an amount of money that we have access to today. And future value is the opposite concept, which is if we have the dollar or whatever dollar amount we have today, we want a method or a calculation to be able to project what will that amount of money be worth in the future based on an investment scenario. And here in the slide we have two calculations that are simply the same formula, either using division or multiplication. We're going to see examples of present value as well as future value now. Our present value example. We have a $60,000 investment, a 3-year time frame with annual cash flows coming in of $10,000, $12,000, and $15,000, and a sales price of $50,000 at the end of 3 years. Our required return is 8%, and that's the key number for our discount calculations. We're going to treat the future cash flows as if they're worth a little bit less because we want the money now to invest it at 8%. If we need to wait a year or 2 or 3 to receive the money, then we want to discount those amounts based on the 8% return requirement. So looking at the calculations at the bottom of the slide, notice time 0, the investment today, has the same present value as it does in the undiscounted calculation because there's no time. That's happening today. As we move out into the future, our total cash flows for years 1, 2, and 3 have a present value amount that is less than their stated amount in the table at the top of the slide because of the discounting factor, because we're using the present value calculation to reduce the value of those dollar amounts. And notice the years row, years 1, 2, 3, those are important numbers because those go into the calculation as a compounding factor. Looking back at the formula, you'll see that you're multiplying the 1 plus yield, or increasing the 1 plus yield by the power of the number of years. That has a compounding component involved. When we add all of our present values, the number is called the net present value, and in this case we see it's 11,146. Anytime net present value is 0 or greater, and I'll emphasize even when it's 0, that means this is a good investment. What the 0 calculation tells you is that your return is exactly your requirement. So if you meet your required return, then it's a good investment. If net present value is positive, then the return is even higher than your requirement, and that also, of course, would be favorable. If you calculate an NPV that is negative, then you would reject that investment. But remember, even a 0 NPV is an investment that is good, that you should approve. Let's look at our future value example. In this case, we want to know what do we expect in value if we invest today $60,000 with a return of 8% during a 3-year investment period. At the end of 3 years, we sell the investment, and given the 8% annual return that has compounded over a 3-year period, our future value after 3 years is $75,583. Now, to give a little more information on the compounding I've mentioned a couple of times, in this example, it will help to work through or think through the concept of compounding. In the first year of investment, I earn 8% on my $60,000, and it's grown to some larger amount. Now the compounding feature is that when I'm investing in year 2, I'm not just investing $60,000 anymore. I'm investing a little bit more because I'm investing my original $60,000 along with the earnings of 8% that the investment generated during year 1. And then at the end of year 2, I'll have an even larger number that will also compound in year 3 because, again, I won't be investing just $60,000. I'll be investing $60,000 that has been growing on a compounded basis at 8% over a 2-year period. So you wouldn't get the same value if you multiplied 60,000 times 1.24. 1.24 is exactly 3 years of 8% return, 3 times 8%, but that fails to factor in the compounding benefit that you have of reinvesting your return, reinvesting your profits. So we use the present value and future value formulas to factor in the compounding feature. And now we have 2 exercises, one for present value calculations with, again, a 3-year project, and a future value calculation, also a 3-year project. And we'll see these solutions in class. I look forward to seeing you then.